Commonwealth Bank fell 10.43% on May 13th, its worst single-day decline since listing in 1991. And the standard explanation is a quarterly earnings miss combined with budget shock. But the earnings miss was minor, $2.7 billion in cash profit for the quarter, down just 1% from the first half average, up 4% on the prior year. A bank earning $2.7 billion in a single quarter does not lose 10% of its market value because profits slipped 1%. It loses 10% when the market decides the price it was paying for that profit was never justified. Before this session, CBA traded at 31 times earnings, against a sector average of 19 times. That gap is not a sign of quality premium alone. It is a sign that capital was parked in CBA because it felt like the safest, most reliable equity in Australia, and that perception, not the earnings, was the real asset being priced. When CBA's own management flagged rising macroeconomic uncertainty and backed that signal with a $200 million top-up to collective loan provisions, the perception cracked. The provisions matter not because $200 million is catastrophic for a bank, with an 11.6% CET1 ratio comfortably above the regulatory floor. It is not, but because management chose to weight its internal models toward the downside scenario, and that choice repriced the forward earnings path the premium valuation depended on. Personal loan arrears rose 30 basis points in the quarter, and consumer sentiment had already fallen to its lowest level since the pandemic, according to CEO Matt Comon. Those are not crisis signals, but they are the kind of signals that force a 31 times earnings stock to ask whether it deserves to be priced like a growth company, when it is, in practice, a mature domestic lender with limited expansion runway. What the valuation unwind does not yet explain is why NAB, trading at 18 times earnings with comparable domestic exposure, fell only 1 to 2% on the same day, and that asymmetry is where the real causal chain runs.
The gap between CBA's 10% fall and NAB's 2% fall on the same day is the most important number in this analysis, because neither the earnings miss nor the provision top-up can explain a differential that large. The federal budget announced on the night of May 12 abolished negative gearing on existing properties from 2027 and replaced the 50% CGT discount, in place since 1999, a period that coincides with a more than 400% rise in house prices, with inflation-adjusted indexation. Jarden analyst Matthew Wilson estimated the combined effect would reduce housing credit growth by 25%, and that single forecast is what moved capital out of CBA specifically, rather than banks generically. CBA holds the largest investor loan book of any Australian bank. Interest-only investor loans have historically delivered wider spreads, better asset quality, and higher return on equity than standard owner-occupier mortgages, which is precisely why they anchored CBA's premium valuation. The budget did not reduce CBA's existing loan book on May 13th. It removed the demand signal that justified expecting that book to keep growing at the pace CBA was priced for. As a counter-signal worth holding, the RBA has already hiked 3 times in 2026, meaning rates are already working against housing demand independent of the CGT change, and some of the credit slowdown is already in motion rather than purely perspective. The question that neither the earnings update nor the budget announcement resolves is whether the CGT reform reaches property prices fast enough to flow into actual mortgage defaults, because CBA's CET1 of 11.6% against APRA's 10.25% minimum means the balance sheet can absorb a deterioration in credit quality that the current share price does not appear to be pricing in at all.
The recovery matters here because CBA closed the next session at $156.42, recovering only 1.8% of the 10% loss, while NAB finished that same day down 1.2%, the only major bank to close lower. That divergence tells a different story than the initial sell-off. NAB's continued weakness suggests capital is not simply rotating back into cheaper bank peers as a mechanical value play. It is pausing entirely, unwilling to price any major bank while the CGT implementation timeline and its mortgage demand impact remain unresolved. Morgan Stanley observed that annualized home loan growth among the majors had already slowed to 3.7% in February, with deposit growth falling from over 8% in prior years to 3.3%, meaning the slowdown predates the budget and is already embedded in the operating environment. CBA at 25 times earnings post-crash remains more expensive than Meta Platforms at 22 times, which carries actual revenue growth expectations, and that comparison is not rhetorical. It is the exact frame institutional sellers are using to justify continued positioning away from the stock.
The recovery pat for CBA is conditional on one of two things. Either the CGT implementation is delayed or modified enough that investor property demand does not contract by the 25% Jardine modeled, or CBA's underlying credit quality, currently still sound with the CET1 buffer intact, holds through the next 2 to 3 quarters of RBA pressure without provision charges accelerating beyond the $316 million quarterly run rate. If neither condition is met by the time the full-year result arrives, the $171.57 close CBA held on May 12th, the last price before the record crash, becomes not a recovery target but the ceiling of the old regime. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.